All right, how's it going, guys? This is Top Down with TCM. I'm one of your hosts, Azaan Barlas, and I'm with my other hosts, Jason Cruz and Weston Weinberg. And we're here today with a former a TCM alum, I should say, Rishub Mogulla. Now, Rishub, would you like to introduce yourself a little bit?
Yeah, sure. First of all, thanks for having me on here. My name is Rishub, and I am a finance major, and I was in the TCM program last year, so for the 2019-2020 year. And I graduated January 2021, so last month, actually. I got my diploma this week, actually, so that's cool. So yeah.
Nice, nice. So first, I kind of wanted to ask you, like, could you tell us a little bit more about your role in TCM and maybe like, if you were in any like portfolio teams or just in general what you got out of TCM?
Right, so last year, first of all, I was a part of the consumer discretionary and communications sector. So, put simply, me and two other people were responsible for managing those sectors. And we made a couple trades.
Mm-hmm.
I personally added Facebook into the portfolio and sold EA from the portfolio. And my partner, Mario, I believe he added to our Activision position, and he made a few other plays as well. So for the first semester, I wasn't part of a specific team or anything per se. I was just like a general analyst, and I can kind of do whatever I want for any portfolio that is within my sector. But starting the second semester, I was a part of the President's Scholars portfolio, and there, I believe I made a couple equity trades or something of the sort.
Okay, okay.
So, for the people that don't know, can you tell us a little bit about the President's Dollar portfolio and how it deviates from the equity teams as well as the fixed income bond one?
Right. So the goal of each portfolio is just a bit different, right? So for equity, I believe it's just to beat the benchmark, isn't it? I believe.
Yeah, S&P.
Yeah, and you can say the same for the bond portfolio, beat the benchmark if it's the ag. But when it comes to the President Scholars portfolio, the goal is it's to fund a scholar, right? And I believe that
Yeah.
scholarship is around $8,000. So the portfolio itself started at around $100,000, I believe. And so the goal was to generate an 8% return. And we wanted to do it in perhaps in more safer manners, so less riskier methods than what we would be comfortable in taking for the equity portfolio and for the bond portfolio.
Mm-hmm.
Um, and I believe we were able to generate our returns for last year. I don't remember, but I think we did.
You're good. That sounds cool. If I may ask, unless you have any questions, Jason, I'm asking another question
Go
about
for it, man.
President Scholars. So,
Mm-hmm.
like, I know that you got reports approved for equity and President Scholar. Like, what was the difference? Getting it approved for President Scholar. Like, did you have to look for companies that are like more value, companies like not growth or like, uh, yeah,
Well, not not necessarily. I think what we had to do is, well, we had to make, like, for example, uh, for the President's College portfolio, I remember we added a Carnival Cruises, and that was right after the pandemic, right? So
yeah,
Carnival Cruises, I believe it is trading at 40.50, and then all of a sudden it dropped all the way down to like 7, I believe, and it was extremely volatile.
yeah.
And so when our portfolio manager wanted to add Carnival Cruises, I was thinking to myself, hey, that doesn't seem like a safe play at all. It's extremely volatile.
Mm-hmm.
Like, how could this fit the President's College portfolio? But the way it works is, I mean, you create the report, you present it to the team, and the team says sure, then you give it to Professor Clark, And if she approves it, then it just kind of goes through. And so with Carmel Cruz's, yeah, that's exactly what happened. It went through. So I wouldn't say there's like a specific growth versus value. I mean, logically speaking, you'd want to keep it more safer, perhaps more value play with some smart growth choices, if that kind of makes sense. But there's no like hard rules. Yeah.
Okay. Cool. Do you guys want to ask a question or?
Yeah, I could jump in. I want to transition out of what we were doing at TCM, and I wanted to ask what you did professionally. So I know you worked at Toro Capital. Whatever it is you could tell us about it, I'd love to hear what you did there.
Yeah, sure. So right after TCM ended around May of last year, I was supposed to graduate at that time, but because of the pandemic, I mean, the job market was just a bit uncertain, and so I just didn't want to graduate immediately at that point. So what I decided to do was give myself extra time so that I have more time to look for a full-time job, and in the meantime, I'll search for an internship.
Right.
And that's how I came across Toro Capital. So Toro Capital is a private equity firm based out of Santa Monica. They are actually how can I say? It's actually based off of a merchant banking model. So what it is the managing directors of Toro Capital, they are actually the managing directors of an investment banking firm called New Century Capital Partners. And they were established in Santa Monica for 11, probably 12 years now. And after, some X amount of years, so around 10 years, they decided, hey, let's create a private equity division per se. And it's its own company, but, the managing directors are the same. And they wanted to focus more on the private equity side. So ETC, Toro Capital, they focus on the cybersecurity, digital media, and SaaS verticals. So when I joined, ETC had just begun their outreach process. So a large component of what I had to do was to reach out to companies within the cybersecurity vertical. That's what I specialized in. And so, I mean, essentially it's a lot of busy work. You got to send emails and whatnot. But what would end up happening is that we would set up calls with many firms. We'd have an introductory call with a lot of these guys. And if it goes well, then we have the second and third call. And then before you know it, you can start doing some research into a specific company and the specific field they are in. If it's something that we're kind of interested in, that's when we start looking at the valuation models and whatnot.
One of the things that I've noticed with especially like private equity funds is you're investing in smaller, private businesses.
That's right.
So it can be tough to utilize fundamentals to make an informed decision for an investment.
Right.
So how do you use qualitative research when it comes to evaluating these companies to see if it might be a sound investment for ETC?
Well, just generally speaking, I think that's what the challenge of private equity even is. You have to have the mental capacity to be able to process through this flow of information and try to pick out what is relevant and what you can use. Now, some sectors, like for example, digital media, there is a lot of information out there on the web, and you'll more or less be able to make some sort of sound decision using what's available. But if you look at cybersecurity, like some of these companies, I mean, you have absolutely no idea what they're doing, and the information you can find online is extremely limited. So what do you do? Well, really, there's only one thing that I've observed, and that's you got to rely on your managing directors, right? These guys have over 30 years of experience in the industry. My MD specifically, they have worked at investment banks in the past. They've IPO'd many cybersecurity companies, and they have a very deep reservoir of knowledge in these fields. So when you're, just like an intern, just trying to figure out what's going on, you have to rely on them and their judgment. And by using that, hopefully you yourself can start to make some sort of connections as well.
So I have a question about their financial data that they give you so that you can actually value something, right?
Yeah.
Is it audited by any chance, the information that they give you, or is it just face value? You just gotta trust it.
Yeah, I mean, like the way it works is it varies, to put simply. More often than not, it won't be audited, and you'll be making those preliminary financial models just based off of what they give you.
Okay.
But that doesn't mean you'll make a deal off of that. So generally, I mean, it's a long process, and what it is once you if you do sign an LOI and everything, there's going to be like a literal 3 to 6 month period where that's when the due diligence really occurs, and that's when most private equity firms will demand an audit. They'll demand like some proper reports. There's this thing called a QOE report, like quality of earnings, where they really dive down and break into the specifics of the company. And if you have questions about that QOE, that's when you ask the the management of the firm, hey, I have a question about this. Why is this the case, or why is that the case? And you try to get more clarity and more understanding. So they may not give you any audited financials, but no deal is occurring without you having those audited financials before.
So,
yeah.
Yeah. So it sounds like you guys are the auditors. You guys are making sure that the number.
Well, I mean, no, I mean, no, we're not, right? Like we'll take the numbers they have, and we'll believe them, I suppose. But unless you have that accounting firm doing the audit, you won't be moving forward with the deal. Like they have to do it. They have to verify the details, and that process, it takes some time. It takes a couple of months.
And then, real quick, in terms of the companies that you guys invest in, what is the revenue per year that you usually target? Like annual revenue?
I mean, it's not about the revenue per year that we're targeting. I mean, put simply, it's highly variable. But what we're looking is for essentially not exponential, but massive growth in the next coming 3 to 5 years, right? I mean, the idea is to exit in 5 years, maybe with a 3 to 5x MOIC. So, in order to achieve that, we got to make sure that the industry that they're a part of is expanding massively, and that these company fundamentals are solid in order for us to make a deal in.
You worked in private equity for, I want to say, about 6 months, I believe,
6 months.
give or take. And I know a lot of our viewers are very interested in starting a career in private equity. So
right.
What I'm wondering is, what sort of skills and attributes do you see as people who've been successful that you've worked with?
Well, obviously you have to have the technical ability to be able to succeed in the field. So I won't really focus on that. I'll try to go more onto the qualitative side, so more of your personality, your attributes kind of thing. First of all, you gotta be, and this isn't like a surprising answer or anything, but you have to be a hard worker, and you have to be a go-getter. These are like some some inherent traits which you must possess in order to find success in this field. I mean, private equity, sometimes you can be working for 70, 80, 90 hours a week. Same as investment banking, right? It can be pretty strenuous, can be pretty stressful. You'll be put on the spot a lot. You'll have to do a lot of quick analysis work. You'll have to provide information to the associates and to whoever's above. And essentially your goal is to make their life easier, right? And so in order to do so, I mean, you have to be on top of your game. If you take it kind of easy, you want to shirk off on your responsibilities a bit, or just have a more simplified lifestyle, private equity will not be for you. It is or it can be very stressful, and you have to be prepared to face that and time manage well.
I didn't realize private equity is so lucrative. I didn't know it was comparable to investment banking.
Oh, I'd say it's probably more lucrative than investment banking, probably. I mean, you notice most people, they do investment banking for a couple years, and then they transition to private equity. And, they both can be very lucrative, obviously, but I think private equity has, well, maybe not, I'm not sure.
I would kind of ask, like, first of all, yeah, like, I always hear of, like, people who are in IB, like, go to private equity, like, years later. Like, every single meme that I've seen is, like, like, my goal is private equity, like, eventually. But, like, what is so appealing about it versus investment banking? Like, why do people like it more? Like, it seems like you're in a higher position, or you have, like, a stronger influence in investment banking, so I'm kind of curious.
I mean, I haven't worked in investment banking, so I can't say for sure. I mean, if I have to put it simply, I think there's just more money making potential, right? And the work you put in can be potentially less than in investment banking. So it just might be a combination of those two. I'm not really sure why people would prefer private equity more than investment banking, and that's because I myself haven't really worked in the industry that much. I only have 6 months in this little private equity shop. It's not really representation of Wall Street per se, so I can't give you a direct answer to that.
Well, it's 6 months more than the three of us combined, so don't be selling yourself short.
Yeah, exactly. I actually do want to backtrack, and this is something I'm genuinely interested in. So, private equity versus public companies. Obviously, public is going to be easier because all the information's out there, and everyone knows about the companies, and then they're full-on auditors, on their financial statements. But how difficult is it really? Like, I don't know if you can gauge it somehow. How difficult is private equity as opposed to valuing public companies?
So in terms of valuation,
just overall analysis, investment analysis. I know it's easier, way easier for public, but I just want to gauge how hard is it.
I mean, if I'm being honest, and I think it depends on the sector, but it can be night and day. I mean, at the end of the day, for public companies, they give you a nice 10K where they give you information about not only the company, but the industry they're working on, who the competitors are. I mean, they give you everything. That 10K is all you need to understand, this company thoroughly and its industry as well. Versus for private equity, I mean, none of that information is available. Right? Sometimes you have to figure out who the competitors are. You have to figure out what these companies' competitive advantages are, right? Like these private equity firms, they'll tell you, they'll give you their version of, what their competitive advantages are and whatnot. But once again, you gotta really filter through all that BS. And so there's a lot of critical thinking involved, right? So, I mean, in terms of how difficult it is, I don't know if I can give you a number. I mean, sure, if...
All right, so to transition a little bit back to TCM, since a lot of our viewers are in it or interested in joining the program, I wanted to ask you, you mentioned earlier that you were in consumer discretionary, in the consumer discretionary team, and that was heavily impacted by COVID, as you were in the fund at the time when it took place. And what I'm curious about is how did you position yourself, or how did you position that sector in the portfolio when, it hit the map? Like, what did you do and what was your strategy?
Well, I wouldn't say, I'll tell you what. So before the pandemic hit, what we were trying to do with the portfolio was that we were actually trying to reduce the number of securities we had. So what the PMs at the time, what they were trying to do was, they realized that, hey, certain sectors have like 8 securities in them, and there's only 1 or 2 analysts. And so what's happening is that it's becoming just a bit too difficult for these analysts to really stay on top of these companies, give the proper weekly updates, and it's just getting a bit challenging, I guess. So what they wanted to do was they wanted to lower the number of securities in our portfolio and increase our position in the securities that we believed in. And so the general idea was, I believe we wanted around 3 securities per sector. So what we were trying to do essentially was improve our selection effect. We wanted to take bets in securities that we fundamentally truly believed in, and lower positions in the other securities. And so, for example, in consumer discretionary, we had both Activision and EA in the portfolio. And so we were thinking to ourselves, hey, why do we have 2 gaming companies in here? That just doesn't make any sense. Let's just take a bet on one of these guys and sell the other guy off. And so what we ended up doing was we ended up increasing our position in Activision, and we completely sold off EA. And that's just kind of like the general process in which we're going through. So what happened during the pandemic, right, when whatever it is that happened, we didn't necessarily change our strategy or anything. If anything, this was a great opportunity to add to our positions. So we still kept up the same fundamental analysis, right? So we sold securities that we didn't really believe in, and equities fell quite a bit, but still we would sell them and increase our positions in securities that we liked in, right? So for example, I remember we added Facebook when it was at like something like 200 or something in like December of 2019. And then, the pandemic happens, and Facebook fell all the way down to 150 or something like that. And I remember we increased our position in it at 160 or something like that. And so just like that, I mean, that's, that similar process we applied all throughout the portfolio. So I wouldn't say there was anything sector specific that we did. Consumer discretionary did take a hit, but honestly, all sectors took a pretty bad hit. I'd say the worst was probably industrials and banks, right? I'd say those banks probably, they both did absolutely terrible.
Yeah.
And we were okay. And really, if you look at the more longer term outlook, consumer discretionary did great. Like we had Amazon what? They went up 70-80%. They like doubled their price. Like they did great. If you look at Facebook, they did great as well, actually. All these social media companies significantly increased in value, and just in general, technology, right? So, I mean, the pandemic was, I guess, a gift to all these tech companies. They really skyrocketed.
It really was, yeah. It was a good sentence.
Great for social media, great for tech companies, and obviously your banks and industrials, are the ones who really took that hit. And if you look at it today, I mean, at least I know banks are coming back, and industrials. I think industrials are still lagging, but they're not doing too bad either now.
Yeah, I know when we took over the portfolio, the current class right now, we wanted to put weight in financials because it was so beat up, and we thought it was going to be, the sector of the pop. And we were relatively right. I mean,
if you look at those stimulus bills, it's been doing some great things for that sector.
Yeah.
Well, Azaan and I, when we were heads of the equity portfolio, I mean, we put a lot of weight in the financial sector. And it definitely performed well for us.
Yeah,
that's for sure.
That's a great call. It's the right call.
I don't know if we were heads, but we were there.
We
were like arms or something.
I was maybe like a foot or a finger. Like,
I was like a pinky finger. Like.
I remember financials, like when we had it, they were falling like 30%, I believe. And yeah, we were like, oh my God, what are we gonna do? And I believe we sold a few, maybe kept a few. I'm not too sure, but yeah, that one hit us hard.
All right, Rishub. We are running out of time. I wanted to finish it off with one last question. You finished up at ETC, El Toro Capital.
Right.
I want to know what is next for you.
Right. Well, so I finished up at ETC just about a month ago now. And so, I wanted to take around a month off. So now that that's up, I will be trying to apply for your investment banking private equity positions, but those are a bit hard to come by. You got to really network and whatnot for that. So while I'm doing that, my dad actually has a wealth management firm. And so it's called a registered investment advisor. So I'll be getting that with my dad's firm. And essentially I'll be eligible to take the Series 7 and Series 66, I believe.
Nice.
So I will be focusing on, doing that, getting those licenses, helping my dad out a bit with the firm. And in the meanwhile, on the back end, I will be applying to, investment banking, private equity. And if those don't come around, then I'll start going to your more generic financial analyst positions, perhaps valuation positions and whatnot. And I'm hoping in the next couple months, something kind of rolls around and I'll have those series licenses in my hand.
Perfect. All right.
Cool.
Thank you, Rishub. It was great having you on. You're an amazing guest.
Thank you guys so much.
Yeah, we'll see you guys in the next episode. Thank you. And fade to black.